Hi, this is Kim Watson. What I want to do in this video, basically a few weeks ago I did a video called Understanding Statistics, and it was a bit of a minefield for some because they realised they had never backtested whatever they had, and they were looking and talking to me, and I was getting emails in terms of, well, how do you do backtesting? I've never tested anything. I was told to do this, that and the other. I've got that written down, so I've got my list, and I just follow it. I've never tested it. So what do you do? What do you need to do to start backtesting? So I thought, well, one, they've got a list of the rules, which is a good starting point, but there are things that you should consider when you're backtesting. And I thought what I'd do is I'll do a series of small videos. I'll try and keep them as short as possible, but the thing is with backtesting, it's quite a large subject, so it may be that we have quite a number of videos, but this is the first in the series of videos, and it's purely on preparing for backtesting, because to backtest you've really got to understand what you're actually testing. Too many people set off with the thinking, well, I've got a strategy, I want to test it, and then they sit there and they think, well, where do I start? Because they've never done anything like this, and well, this is hopefully, well, I'm going to be helping you to where you start. Now, the most important thing, well, there's four most important things, or four parts of this which are most important. First part is the signal. You must have a signal. I'm going to go through these in a bit more detail in a moment, so don't worry. Signal. You must have a trigger. And as I say, I'll explain these in detail. Signal, trigger, and then the part of the signal and the trigger are one thing, and I'll call this a condition and additional conditions, and I'm going to put time here. I'll badly spell time. I'm going to, you know what I'm conditions. I know it looks like something's crawled over the screen, and yes, I am using a proper mouse pad and everything else, but I've got four screens here, and it's so sensitive it will write over the four screens perfectly. To write something on here is not so easy. Anyway, signal, trigger, conditions, time. I'll come on to all of these in detail. And the fourth item is exits. Now this is for both the stop, which is the obvious thing, and of course the targets. So this is, at the end of this session, you're going to be in a position that you fully understand these parts, and you can take your strategy and break it down and have everything ready to start backtesting. Unless you've got this all in order, you're going to struggle, and it's going to be very difficult. So I'm going to just do it. The first process then is fully understanding your strategy. So let's get on and move to looking at building what do I mean by signal. So simply, and I'm going to give you a very simple process of what the signal is, or could be. It's not is, could be. Let's say you've got there's a series, it's called a pivot swing. You can look it up and search it or whatever else. I can give you details of it. Maybe if you really want, I'll give you the formula of identifying what a pivot swing actually is. Just ask. But you take the signal, if you like, or the three candles. In this case, that may be the absolute signal. So if you see that, it's the signal. Whatever it may be a moving average crossover. If that's it, that's your signal. So that is the detail of it. Now, so some people like dojis, or haramis. Someone mentioned, it's funny, but someone mentioned both to me today. They looked at candlestick patterns, little bullish haramis, badly drawn ones. I'll show you some on the chart, it's easier. They showed me these, and whatever it may be, that might be a signal. I've got an indicator which comes up and it just gives two colours. You've got red at the top there, which is effectively an overbought signal, and you'll have a green signal at the bottoms, which is an overbought and oversold basically, and it just does that. So that is classed as purely as the signal. So that's all you've got to do. You've got to be able to write it down so it's fully understandable by yourself, because I say this because people start off with it and they vary it, but it must be the same thing, or if it's a number of things, you write the alternatives. It may be that you're happy with just 2 candles sometimes. I would test them separately, because if your signal is too varied, it's hard to measure, because well, it's just damn hard to measure. So make sure it's completely readable, understandable. If someone that doesn't really trade would look at a chart and say, there it is, that's what you just described. It may take them a few moments to get their eye in, but you need to have it clear enough to show someone that's not sure, or another trader, so that another trader test it on a trader friend or something like that. Can you see this in the market? This is my signal. Okay, so that's your signal itself, he says. There are then behind that, I'll come to the conditions third. Second point then, I'm going to talk about the trigger for the signal. Now there are 2 different things generally. The 3 candlesticks here would be, as I said before, or 3 bars, doesn't matter what they are. That would be the signal. How do I trade it? When do I if this was bearish, for example, and I was looking as a reversal signal, when do I actually press the sell button? Because if I've got to wait for that to set up first, then I need to know, when do I do it? Do I just, when the next bar? If it does it matter where, if it's closed here, for example, around this area? Does it matter if it starts moving in this direction and I want to be short? Do I just sell anyway, or do I wait for it to break the low of the 3rd bar, for example? If that's the trigger, and again, does it matter if it's the first one, second one, third one that's after that bar? So you need to consider what you would accept. It may be that on the trigger you may record, well, actually I'll look at it when it's the first one, and I'll maybe look at it on the second one as well, because sometimes could show you examples of this. It doesn't always set up immediately. I mean, you might say, well, actually the momentum's not so good, but it may be just a little retrace and off it goes again. It goes in your direction. So you might say, well, actually, if that doesn't break on the second, but on the third it does break, fine. I'm quite happy, and I'll accept that. But it's got to be clear enough, again, for you to share with a trading person, someone else that's got a bit of understanding. So you say, it's got to have these 3 bars here. These are the rules with the 3 bars, what they've got to be doing. So you give them the rules of the 3 bars, then you give them when would I take the trade, and so if they didn't know anything else, so they could say, oh, actually it's got to be the next bar when it breaks or even closes below. You could have whichever it is, up to you. I mean, whatever it is, you just tell them exactly what it is. So let's just, for simple case here, you can say when it breaks that level, and you just write that down. Now I'm not giving you a strategy here, guys. I'm just giving you the idea, the principles behind the strategy, building the strategy and what it is. Okay, so we've got a signal, we've got the signal, we've got the trigger. We next need the conditions. Now it may be that these 2 are very much interlinked in terms of single, and it may be that the conditions are written within there, but as I said a moment ago, time is an important condition. It may be that all the descriptive part of the signal is up here, as in whether it's a bullish version or a bearish version, and you should have both, because otherwise how do you know whether to go long or short? So you should have a short version and a long version of the signal written clearly. and the conditions may just be the time. What else? News. Should I be trading it whenever? Time is a very, very important one, because if you're only able to trade between X and Y, and yet you're testing it between well, A and Z, and your X and Y is there, you've got a lot of time when you've tested it when you're not going to be trading it anyway. And if all the winners were in this phase and very few in that phase, or you've got quite a few good ones in there, that's fine. But it may be that you're still it's got to be about the time you're going to be trading it. So if you're a day trader, or let's say day trader, don't have to be sitting there all day. You may be, well, I've got until 10 o'clock in the morning, and then I've got to go off and do things. Or I can take a trade in between that time, between 7 and 10. And you put those as your time. That's the point you're going to be trading it. So it's great to know it's working really well at 3 o'clock in the afternoon. But if you're not around for 3 o'clock in the afternoon every day, well, maybe not the right strategy, or you change things around. Now you can test, I mean, the whole day, but and it may be a good process to do. But I personally think you're better off testing it largely in the time that you're going to be around to trade it. News, you've got to take account of major news, non-farm payrolls, central bank meetings, maybe inflation, jobs, other jobs, wages, etc. Apart from non-farm payrolls, I do realise. But you've got to decide on what news is key not to trade in. Perhaps we could look at this as one of the other videos. Let me know if you want me to cover it, I will. But the important thing here then is you've got your conditions. You've got your signal, your trigger, your conditions. So you're getting on nicely down the road, ready. But of course, as I mentioned, period number 4 then was the exit. Now I just refer to this as exit because I think it's quite a good description of what you're doing. You're exiting the trade. How it's exiting is one way or the other, but you will need to consider how you place stops and what you consider for targets. So it's a two-pronged area here. I would strongly recommend you use stops. Only fools get away with not using them for a while, and then eventually it catches up with them. I've seen all sorts of things done here for people not to make losses. They start hedging, and then they get into a real complicated move, and they've built up their hedges, and they get into a position where they've got too much margin, and they get margin calls, and then all of a sudden it goes a bit pear-shaped. So do not leave out this. This is a very important point. When is that trade no longer? When should I clear it? What should be the criteria? That criteria should be clear. I mean, a standard amount of pips is possibly not the right idea, but again, if you want some ideas on this, I can put it on a future video. But what it should be is a logical stop, more so. I have done with set numbers of pips at times. It works okay, but there's the thing is, when you're looking at the market and you're looking at previous highs and lows, it may be that you don't need such a big stop. Other times it may be you need a bigger stop. So consider what it's going to be, but it's got to be something that's clear that you can repeat, and again teach someone that's never traded that much. Target wise, now often people try and out-trade me, and they do out-trade me, I'm sure, some of the time. On targets, I'll be exiting for a specific reason. If I've seen something that's got oversold down here and I've gone long, and all of a sudden it's given me an overbought signal, I might clear out the whole trade, might empty it out, and that may be and if it's done that and it's already reached the other criteria I might have had, the moving average, for example. If it's already meet that and it's gone through to here for the second part, because you can do second 2 parts or 3 parts, it's up to you. But second part of the target, once that gets up there, for me, I'm out. Other people will hold into the position, and sometimes it will go marvelous for them, but quite frequently when if it's overbought at that stage, I'm getting a signal. So it may be time to be looking the other way potentially. Okay, so you've got to know what your targets are though. Just saying, well, I'll go for X, Y, or Z. I have again tested things which have fixed stops and fixed targets. Work some of the time, sometimes the stops are too much, sometimes the targets are too little. You can obviously, when you're doing a fix, you can have a fixed rate risk reward, but surely you should be trading to what the market is telling you. So you need to have a clear idea of, is that target achievable? Is that stop big enough? Is it too big? You need to consider this. So that's pretty much it for this video. I don't want to go too much further, but let's just summarize of where we've got to in terms of running back through all the factors that you need to go through now. So number one, you need to have the signal. Whatever it is needs to be completely described out there. Number two, you need to have the trigger. How do I get into this trade? What is the trigger for me to buy or sell that trade? 3, ensure you've got the conditions, and of course the trigger will include the conditions but I've put it as a separate factor here, and the signal may have certain conditions as well, but you've got to have sufficient conditions. All these listed out will give you a number of factors which you're going to be testing by. So do consider not tightening things up massively or making things massively onerous. I've had spreadsheets with 26 or 30 columns across them in the past, and I can assure you by the time you've got to about the 15th test or sample, you're just brain dead by that stage, and it's harder to test and do it freshly. So consider the conditions and don't overly tie yourself up, but make sure it's clear and there's sufficient. And then 4, look at the exits, both the profitable and the stop loss. So look at both exits and where you're going to get out. It's always important to have all these things ready before you even consider a trade anyway, regardless of your back testing. If you do not know all of these before you take the trade, then you really shouldn't be trading at that stage. You need to go back to the drawing board, check it all out, and have your checklist effectively. Checklist for your signals, the conditions around taking the trade, the trigger, whatever it is, any conditions that may come into play there. Don't forget, as I say, remember the news, etc., and then your exits. Okay, so that's your first task then. If you really want to get into back testing, make sure it's all very nice and clear. For some people it may be so simple. In fact, what I'm going to do here is just give you I was looking at this, we were talking about this morning. I talked about a 3-bar signal here. It's called a pivot swing. They're the 3 bars here. It could be that could be the signal, for example. There's another one here. There was another one there. There was little ones, micro ones sitting in between where it wasn't so defined. There was one here. There's loads of them. There's another one here, and yeah, it looks fantastic retrospectively. It's not so easy always to trade it, I can assure you. But anyway, that may be your signal, and it may be that you say, well, actually I won't take that one because part of my conditions are, for a bearish one, it needs to be below the 50 moving average. Consider the time frames. Of course, this is a 5-minute. It's probably far too faster time frame or shorter time frame for some people, signals and trades, to get a decent return. But again, things to consider. But in your conditions and the moving average there, it may be that okay, it's got to be below the 50 when it sets up, etc. It may be some other factors that you've got in there. The trigger may be on the break of the next bar there. As I said, just straightforward trigger. Your stop, in this particular case, it might just be to just a pip or two bit above the high there. Your target, it may be whatever you're looking for. I mean, I use pivots a lot for targets because I know whether things are achievable during the day statistically. But It may be something on the bigger time frame you're looking at, and remember time frames backwards and forwards is part of the conditions there, so you need to look up and down the time frames to what you're doing as part of your conditions, and when you're trading it. So another factor. So there's quite a few factors in there, but you've got to get it all listed out in terms of what you're going to be doing to do, and then your targets. It may be, some people may just say, well, I'm going to take a minimum of two times the risk. Might work in a more trend following type trade, may work quite well. There may be other factors that you consider, but whatever it is, whatever your trigger is, if it's a reversal trigger, for example, a back mean reversal, you may be looking at a 50 or a 21 moving average, which are quite common. Price comes back to them quite frequently. So whatever it may be, that's the sort of things you've got to be working out, as I say, and detailing. So that's just a brief summary there. Right, I wish you good analysis for actually writing everything down. As I said, if you've got questions, pop them on at the end of the video in the notes section. If you like the video and you want to see more, please like this video. And that's it for me. Have a great one. Bye for now.